First real estate deal I did was in 2013. I was utilizing a tool that veterans have called the VA home loan. I found a house that could be a house hack, so live in it while I flip it, and I used my VA home loan to do that. When I moved from California, I made about 130 grand off that first deal.
You've gone through mentorship programs, masterminds, all that stuff, and you mentioned that it kind of folded the amount of time that it took to make that leap.
We're talking big numbers now. We're not talking hundreds of thousands of dollar properties. We're talking millions and tens of millions of dollar properties. So a tiny little mistake can cost you six figures easily. So to have somebody that's been there and gone through that, I think to me is priceless to have that experience on tap for you.
Welcome back to the Hybrid Real Estate Professional Podcast, the show where we help you build a life of abundance and financial freedom through real estate investing without sacrificing what's most important to you. Today, I have a special guest, Vince Gethings. Vince is a playbook in action. He started his real estate journey with a $0 VA loan, and now he oversees a portfolio of $100 million in multifamily. He operates 6 businesses and leads a thriving family of 5. He's not just a founder, he's a systems builder, a community contributor, and a 16-year Air Force veteran who knows how to lead under pressure. He brings the exact kind of story our listeners need to hear. Vince, welcome to the show.
Thanks, Aaron. Happy to be here.
Yeah, so I went back and listened to a few other interviews you've done, and your story has quite a large spectrum, but I do think the origin, that kind of first deal that you did is a good place to start. Can you kind of trace that for us?
First real estate deal?
Yeah.
We're going? Okay, cool. First real estate deal. All right, so first real estate deal I did was in 2013. So 2013, I was stationed at Travis Air Force Base, California, and I was utilizing a tool that veterans have called the VA home loan. If you're a veteran, listen to this, and you're not using your VA home loan, you're messing up. It's literally the best benefit that you've earned for wealth building the whole time for you serving. So use your VA home loan. So that's what I did. I found a house that could be a house hack, so live in it while I flip it kind of thing, and I used my VA home loan to do that. So from 2013 to 2016, I lived in this house, used my VA home loan, sold it when I moved from California, and I made about 130 grand off that first deal. And that from that point on, I was like, real estate's screw the stock market, like real estate's where it's at. Because up to that point, I was doing some stock trading and things like that, trying to learn that market, but the real estate bug got me. And that was my first deal. And then I took from 2016 to 2018, I reinvested that 130 plus I liquidated all my savings, all my brokerage accounts, and I started buying rental properties, small rental properties, single families, duplexes, fourplexes, up into 2018. And then that's where I got my first or initial portfolio of 20 units, all while working my W-2 job in the military station. At this point, I was in Hawaii. So I was in Hawaii buying single family and these small multifamilies in the mainland, as we call it. And that's what started my journey for real estate investing.
Awesome. Yeah, there's a lot of stuff to peel back there. So when you did the first one, it was a house hack, so you lived in it. Did you at the time have any idea that you wanted to hold on to it afterwards as a rental, or did you just buy it like, hey, I'm going to buy a house and I'm going to live there?
At that point, it was the idea was to flip it after I PCS. So when I PCS is when they station you at a different place, that was always the plan for that one. Is I'll live in this house, and then when the Air Force moves me to another base, I'll sell it and then do something with that cash. I didn't know what it was. But by the time I was educating myself more as I was living in the house from 2013 to 2016, by the time I was ready to go and sell the house, I already had more of a game plan. I had more knowledge, more education to, buy the next ones.
Yeah, makes sense. And it sounds like kind of by virtue of the fact that you had to move around a lot, you became a long distance landlord, long distance investor. Was that a hard shift for you when it happened? Or did you kind of feel like you said, you leaned in, you were learning, you were building all the skills and falling in love with real estate, I suppose. Was that a hard transition when you had to start doing that from a distance instead of you being in the houses yourself?
For me, it was kind of easy because the markets I was in. So I was in Bay Area, California first, not a great place to own rentals. And then I went to Hawaii, not a great place to own rentals. So for me, it was like, if I want to do this, I had to find a market that made sense. At the at the time, the Midwest made sense based because my budget, I didn't have a whole lot to work with. So Midwest provides affordable rentals. So that kind of narrowed it down. And then from there, I found what we would call a competitive advantage. So for me, it was Michigan. As we spoke before we went live, my ties to Michigan is actually my wife. Her family's from Michigan and they lived there their whole lives. So I was like, well, if I'm going to be overseas and I want to invest, where can be some place that is stable? I'm always going to have, roots in, and someplace that I have people there I can trust on the ground to help me look after things and not just a property manager that I hire. So even though Michigan itself is not a great market to invest in, it's kind of slightly declining population, job growth, income growth, not really there. There's much better markets. But I had that competitive advantage, which was my wife's family. They can go check on my contractors, check on my property manager, make sure the properties are kind of look after it for me a little bit. So that kind of overrided some of those other KPIs. And I chose Michigan as the place I was going to invest in. And I was in Hawaii buying these rental properties in Michigan. So that's kind of how I went there. And it essentially out of necessity because, the rental properties in California and Hawaii one, they're out of my price point. And two, they don't really cash flow. So that's where we ended up.
Yeah, makes sense. And one of the big niches that I do, so I'm a long distance investor too. We own 8 rental properties. The closest one's 1,000 miles away in Iowa. And then we have some in Washington and Nevada too. So big fan of that strategy, especially if you're in a market where it doesn't make a ton of sense to own rentals, the big expensive coastal markets or Hawaii, like you mentioned. So it sounds like you're basically self-managing these properties, except you had, like you said, your wife's family and you had some boots on the ground. But did you have a third-party property manager, or were you?
At this point, I did. So at this point, I still had a third-party property manager, and I needed somebody to kind of look after them to make sure that they were doing what they were supposed to do. And that's where kind of my wife's family and my brother-in-law, sister-in-law kind of come into place. Actually, I have a better analogy for you and for your listeners is the way I pictured it was like a Venn diagram. So I had the one circle was the property manager, right? They kind of gave me their story, what was happening. Then I had my wife's family who don't do real estate, but they kind of give me the, hey, this doesn't look right kind of thing. Like, I don't know what right looks like, but your grass is a foot high kind of thing, right? So they would give me like that kind of stuff. And that would be another circle in the Venn diagram. And then I actually found a investor from Bigger Pockets, and Bigger Pockets was kind of in its heyday during these years. I actually was like, when I'm Bigger Pockets, say, hey, I need somebody in Bay City, Michigan to kind of help me out. And I would pay this guy, Manny. I'm still friends with him today. We're talking, over 10 years later, I still talk to this guy. And I was like, hey, Manny, I'm this guy. I'm over in Hawaii. I just need somebody to help look after properties for me that has the eye of an investor. I'll give you $100 every time I call you to go check on something. He was like, sure. Like, that's a no-brainer. So we're still friends to these days, done deals together. And then he was the third circle of that Venn diagram. So I figured there's 3 overlapping circles of each of their different perspectives. And I'm in the middle of that circle. And I was able to feel very comfortable with each of these different stories. I can kind of put together what the real story is and kind of checks and balances. And I felt very comfortable, being overseas, essentially buying these properties and managing them. So that's how I solved that problem of being so far away, but still confident that, business was getting done correctly.
Yeah, that's a really smart approach. And it validates one of my big beliefs now. So when we first did long distance investing, I was overly indexed and overly reliant on our property manager. That was a thing that, you basically have to take their word for it. And unless you can go visit, you have no way to really verify. Maybe they send you a picture here and there or a video walkthrough, but there's always stuff that they could be leaving out. So having another party, or in your case, 2 other parties that are unrelated to provide that check and balance, that is really how you can be the most confident you can be. You can never fully eliminate risk, right? But you at least feel like you're gathering enough information from enough sources that you can, sleep easy at night, I guess. And Hawaii is not exactly, that's 5 time zones away, right? Or 6?
Yeah. Well, it depends what time of year because they don't do daylight savings. So it's either 5 or 6.
Yeah. Yeah. So it's not like you could just jump on a plane and be at your rentals, later that day or anything like that. But
yeah, exactly. And it's every property manager I've ever had. And it's been a lot these days. If I look back, probably a dozen property managers, more, maybe 20, 30. And it's like they always kind of leave something out, or exaggerate, the effort that they put in towards something. So it's always good to have the checks and balances to make sure something's getting done the way that, because lot of times they would just drive by my brother-in-law, sister-in-law, they would just drive by on the way to the grocery store and like take a picture and like, hey, you know, you got trash on the like side of the road here. What's going on? You got a couch sitting out front of your property, you know? So that stuff really does help.
Yeah. And then you're like, why did the PM not tell me that? Why am I hearing it from you instead of my property manager that I'm paying?
Exactly. So it kind of kept it pretty tight when I had that small portfolio.
Yeah. Very nice. So I know that is only chapter one out of what has become a long journey for you. But before we get into the rest of the real estate, I should have led with this, but thank you for your service. It's amazing you've been, in the Air Force and able to balance all these other things. But can you talk about so you were moving across the country, sometimes, like you said, even overseas, like, long distances. You had this portfolio. You also have kids. Like, what were some of the things that you did along the way to be able to balance all this stuff as you were growing?
I'm not really the best for balance. Definitely a bit of that ADD or ADHD stuff. So I don't do well with the whole balance thing. What I have found a better, I guess, compromise would, if you ever read the book The One Thing by Gary Keller, phenomenal book. But I think in that book he's like balances the myth as well. It's you got to be all in on this and just try to focus as much in the flow state on this one topic, knock it out, and then when that one thing is done, then you can go all the way here and then give your family 100% of your attention. And so I think, yes, it ends up might being more of a balance, but for me, I think about it more like that. Like when I'm working on this task, I'm going to try to give 100% on this task, even if I have to burn some midnight oil, work some weekends, and then I can give my family, their 100% attention. So the balance is a little hard. There's definitely some sacrifices if you're trying to build the wealth and, keep your W-2 job, maintain a good relationships with your family. But I think I've done pretty well doing it, but a lot of it's just nights and weekends until I can hit that critical mass point where I can, jump out of the W-2, so to speak.
Yeah, no, I appreciate your candor there. And it's a really important point because people talk about balance as if it's this somehow like permanent equilibrium where you're just like constantly like always giving everyone exactly the right amount of attention. You're always getting exactly the right amount of sleep and exercise, but it's never that clean, right? It's always an ongoing struggle. And a lot of the entrepreneurs and the highly driven, high performer types that I've talked to, they say something very similar to what you said, which is like there's periods of intensity, there's periods of like really like late nights and weekends and finding time in the margins of your schedule. So after your W-2, after the kids are in bed, whatever it may be, and having to use that, right, and making those sacrifices. Like there's no easy button, especially when you have kids and a demanding job. So I appreciate that candid response.
I think more of the balance comes into focus, and maybe it's more that I'm getting a little older now, but being aware of how my body's reacting to those periods of intensity. I think that's a little bit more kind of forefront these days of like, I can notice a lot more when I'm like approaching like burnout, like, and I'm like, all right, I got to pull back a little bit for a couple of weeks and stuff like that. So it's a little bit more on that spectrum of when I'm actually try to force balance into my schedule or force like kind of those downtimes is because I can, sometimes I can go, all out for a period of time. And then my body starts telling me, hey, slow down. And then I got to pull back a little bit and then drive up again. So, but I also do a lot more than most, we have 6 companies, so it's not common, what I normally do.
Yeah. So let's go there next, right? So 2018, I think, is when you said you stopped, or that was when you had built your duplexes and you shifted towards the 20 unit. Did I get that right?
The 20 units are made up of the single families, duplexes, fourplexes made up the 20 units that I had before I jumped into multifamily.
Okay. So let's talk about, I guess, the pivot where you started shifting towards multifamily.
Yep. So the people, to kind of put a bow on the earlier stage, the first stage is 20 units, is when you're getting into that space, the single families, duplexes, fourplexes, it's a great place to start. The properties aren't big. You can make mistakes. You're not going to go bankrupt making a mistake on a duplex, things like that. So it gives you the kind of the sandbox, so to speak, of you to kind of explore the multifamily or real estate game and build your systems, processes, figure out, that kind of stuff before you want to jump into the larger multifamily. The downsides of that is going to be, one, you're in mostly conventional properties. So you're doing the 20% down, getting a conventional loan, and then those run out after a time. Like the bank's just going to stop giving you conventional loans. Plus they all go on your personal credit. So you end up just tapping out on the DTI, your debt to income, just ends up tapping out. And then you have to force yourself to be, the real investor, which is like once you start jumping to commercial and you have to start getting business loans, they joke with you on is like, now it's time to become a real investor is the joke they gave me, which is like, all right, now I have to go figure out how to get business loans and commercial real estate loans. All right. So that was kind of where I was at. So a lot of people hit this plateau they hit a couple rentals and they hit a ceiling. They can't figure out how to get over it. It's very, very common. A lot of it is, like I said, the DTI. They don't know how to get business loans and talk to those lenders or brokers and whatever. A lot of it is they've kind of tapped out because they already spent all their money on the first rental. So where do I get the money for the next ones? And then there's just the sophistication of the investor of how to underwrite, find these commercial properties, how to underwrite them, how to structure them, how to manage them. So it's a lot more intimidating once you start getting into the large apartment complex. So a lot of people hit this ceiling. The way I got out of it, and I hit the ceiling in 2018. The way I got out of it was I went and got coaching and mentorship through a program. And I was like, all right, I'm going to research a lot of them. Found one I resonated with the most, jumped into that one. Within 6 months, I found a 52 unit apartment building. I went to my local real estate meetup out in Hawaii, found 3 guys that was passionate about real estate as I was and apartments and had money and were willing to give it to me. So we all partnered up. The 4 of us, we each put in 25% and we bought this 52 unit. And that was the start of Tri-City Equity Group, which is the company now that is, 100 million in assets. We've done 18 deals together. Seven or 8 of those have gone full cycle. So it was a great start in 2018. But that point was when you hit a ceiling on the single families and you want to make that leap. That was 2018. I shortened that curve by getting coaching and mentorship group. And that was the thing that changed it all for me.
Yeah, I was going to probe into that a little more. So obviously you and I we're in a group together. Like I know you're in several other, you've gone through mentorship programs, masterminds, all that stuff. And you mentioned that it kind of folded the amount of time that it took to make that leap. But so you said you looked at a few different groups and programs. What was the deciding factor that made you go with who you went with? And do you feel like you could have done it without that type of support?
The factors that I was going through, so there's a couple big ones at the time. There's more now. It's a little bit more competitive in that space, and you got to kind of watch out for like the kind of the fake guru type stuff. But the guys I went through now, their reputation was like flawless. Like they had a great reputation, and they were actual operators, vertical integrated operators, meaning they own all of their properties themselves and they manage all their properties themselves. And for being somebody that is a very hands-on person, I appreciated that they focused so heavily on operations and not just brand building, raising money, and buying property. Because I've owned a couple of properties, so I know that managing these things are hard. So I wanted to find somebody that was like, who's going to help me with the management piece? And that was that one thing that kind of set these guys apart. Besides their reputation, was they weren't just teaching how to find and raise money, but also how to close the deal and manage and execute a business plan on a multifamily asset. And that's what resonated me with them. So I joined them, and that changed everything. You asked if I could have done it without it. Probably not. I'd be nowhere near the scale I'm at now. Maybe I'd probably be a fifth of the way I am now, and I'd probably would have lost tens, hundreds of thousands of dollars in mistakes that I've made. Just countless mistakes bypassed by having, the coaching and mentorship. Like, Vince, don't do that. Like, here's why. Everything from writing an LOI and missing something, doing due diligence and missing something, doing underwriting and missing something. Like, there's so many things when you're in the larger multifamily commercial assets, so many kind of tripwires and things that could get you caught up that could cost you. We're talking big numbers now. We're not talking hundreds of thousands of dollar properties. We're talking millions and tens of millions of dollar properties. So a tiny little mistake can cost you 6 figures easily. So to have somebody that's been there and kind of gone through that I think to me it's priceless to have that experience on tap for you.
Yeah, I think a couple of things you said really, really resonate with me. One was when you're talking about the single family and the duplexes and the small multifamily, you used the analogy of a sandbox, right? It's a place where you can go explore. You can make some mistakes. You will make some mistakes, and you could do it without taking yourself down, taking your family down. At that point, it sounded like you were using largely your own money. So if you made a mistake, it wasn't at the expense of an investor who trusted you, right? So that by the time you got to these bigger deals and you had your mentors and you had the experience that you had, you were a much probably better steward of people's money than you would have been if you tried to jump straight into that on your own. So I like the sandbox analogy. That's a lot of people that I interact with today, that have that similar journey where they start with the single families and then they're trying to, maybe graduate into some of these bigger
Yeah.
asset
Or,
classes.
or on the other side of it, and which is completely okay as well, is they realize that they don't like this. And it's like, it's like, hey, this isn't for me. I'm going to go back to the stock market or just give my money to, my fund manager or whatever, because it's just too much for me. I just don't have the stomach for, some of these problems that come up. And that's okay too. Cause like, hey, you tried it out and it's not for you. The worst thing is like, you get these people that they get these kind of the visions of grandeur or whatever. And they jump out first deal 100-unit property that they syndicate and they've never done real estate before. And then they're like imploding under the pressure of it. And I'm just like, oh man, like hopefully we can untangle this and, get your money back and you can come out unscathed. But I definitely shy away from that side of it. And like, hey, let's just start small and then, scale up from there. Once you figure out what you're good at, what you're not good at, what you like doing, what you don't like doing, things like that. And you can really start kind of build, what angle of this game are you going to play in? Maybe it's just the money raiser. Maybe it's just the boots on the ground. Maybe it's investor relations, something, I don't know. But do it on a small scale where it's nice and, easy to manage.
Yeah, it's a really good point because a lot of people love the idea. And then when it gets down to it, they're not actually interested in doing that type of work. Even if they know that the long-term, benefits might be great, it just doesn't gel with their lifestyle or their interests. And then you also, like, a really, really good point is that the skill of finding a deal, underwriting it is totally different, completely different than the skill of executing a business plan and managing for a 5-year life cycle, doing renovations, value add, and then finding, financing
or investor relations and stuff like that. Like that's something I know is a weakness for me. Like, yes, I can raise money and I do kind of hold my own in my deals, but I have like partners that like, they thrive on it. They have no problem, whining and dining, doing the investor dinners and all that stuff. And they have the charisma for it and all this stuff. And I'm just like, that's their strength. Mine's operations. And I'm completely okay with that,
Yeah. Acquisitions and capital raising, investor relations, that's sales and marketing is what it really is. And those are critically important when you're building a big business, but it definitely, you need the integrator, you need the operator. And I saw in your kind of resume and some of the stuff I listened to before that, like, I think you're trained in Six Sigma and process improvement. And like, I think you're naturally gravitate towards operations and systems thinking. Is that also born from kind of some of your experience in the Air Force too?
Yeah, I got those in the military because I was in aviation in the military or in the Air Force. So I was in aviation maintenance. So it was very regimented, very, by the book, run the process, lean, get efficient was kind of like our whole thing that we did for, 16 years. So that was definitely from that. And so I just gravitate to more of the hands-on, side of the business. I like the problem solving. I like the taking the pieces and I was like, I can figure this out. That's where I thrive. That's my kind of genius area.
Yeah, no, and every company, especially if you're going to scale the way you have, needs somebody who thinks like that. And so you mentioned you have was it 2 partners that you started and that you're still with?
I had 3. So the original Tri-City was 4 people. So me and 3 others. Out of those, we still have all of us but 1. So we're all still together all these years later, except for 1 guy.
So I have one question about that. So partnerships, especially when you're scaling and creating, tons of value and expanding into different types of verticals, partnerships are really hard to architect in a way that will last for a long time. Usually when people start them, they're really aligned. Everyone's excited. They're on the same page. Usually you rally around a certain idea. But then if you, fast forward 5 years, people have kids, their parents, stuff, people move, whatever may happen in life. It's really hard to stay together, keep a core together for 5 years. So my question is, when you guys formed, did you guys have a framework for like the long run or did you guys start and just kind of like build the ship as you went? Today's episode is brought to you by the Remote Real Estate Academy, the community I launched last year where I personally coach investors and empower them to buy rental properties anywhere in the United States. My business partner Nathan and I have a collective 15 years experience with over 20 cash flowing out-of-state rental properties. We provide a step-by-step playbook on how you can build your own portfolio and start accessing the life-changing benefits of real estate investing starting today. Go to remoterealestateacademy.com for more info, or better yet, shoot me an email at aaron@aaronamin.com with subject line RREA, and I'll throw in a special bonus for podcast listeners who join the Academy. Now let's get to the show.
I got really lucky And I actually have an entire presentation specifically on intentional team building. I can kind of give you the cliff notes for real quick, but I think I got really lucky because I didn't really do a whole lot other than just like who's passionate about this thing. And like, so most of the people that I mentor or I coach, I try to caution them heavily on this part because this is a part of the business that people kind of gloss over, and they get in this honeymoon state with their partners, and they usually ends up calling me. I was pretty surprised at 5 years because usually the calls I get is like 6 to 8 months. They're calling me like, Vince, I hate this guy. He's never showing up. Like all the meetings, I'm having to do 80% of the work now, but he's getting 25%, the 50% of the equity. So the way I teach intentional team building now, or I'll give you the clip notes of it. So first you have to get really familiar with the seats that need to get filled in this game. For me, it's 5 seats. I boil it down to 5 seats. You have your deal finder, right? Your risk capital, which is your earnest money, sunk costs for legal fees, inspection fees, all that stuff. That could be 50 grand, 100 grand, sometimes higher, but the risk capital money. You have to find the equity raise, like who's going to put the downstroke for the down payment, the working capital, the capital expenditures, where's that's coming from or who's raising it. Then you have the KP, the key principal, who's signing on the loan, who has the net worth and liquidity to satisfy the bank requirements. And then you have the asset manager, boots on the ground, person that's actually going to execute the business plan, right? So in the deal, any deal, those 5 seats need to get filled. What I usually see, and this is the first mistake I see new investors make, is they meet, me and Aaron meet up at a meetup at, some kind of social thing. And, like, oh, you want to do real estate in Houston? I want to do real estate in Houston. Let's go. And then next thing you know, we're under contract on a 20 unit or 50 unit or 100 unit, whatever it is. And then we sit down and like, all right, who can raise money? I'm like, I can't raise money. I've never raised money. I can maybe raise 100 grand. And it's like, well, it's like $1 million. Like, where are we going to get that? Like, well, what's your balance sheet look like? Well, I got this much and I got this much. Well, we need that person too. So, and then next thing you know, it's like we have all these gaps in our team, and like, all right, we'll bring more people in, and then we'll bring more people in, and then next thing you know, that your team for JV or syndication or whatever you're trying to do is like 10 people deep, and it's like, wait, why are we even doing this deal? That we're so diluted here that it's not even worth doing, and because they weren't intentional on building your team. So the first thing you need to do is understand the 5 seats that need to be filled in. Then you have to look at yourself. Be really honest with yourself. What are my strengths and weaknesses? What am I good at? What am I not good at? What do I like doing? And what do I don't like doing? Right? And get really good, like almost like a SWOT analysis on yourself. Like, what are those seats can I sit in and what can't I sit in? And, what are my strengths and weaknesses? Then the part that everybody kind of breezes over is getting really clear on your goals, what your vision is, like this 5-year, 10-year vision is, your timeline to achieve that, right? And your core values. And it sounds like the foo-foo stuff. Like, what does that have to do with real estate investing? That's like the inspirational Tony Robbins stuff. I'm telling you, this matters more than anything else when building a team, because what's going to happen is two failures on this point is, one, you get to grinding and you grind for years, and then you start climbing this ladder. If we're using the Stephen Covey analogy here, you start climbing this ladder, and then you get to the top of the ladder 10 years, 20 years from now, and you realize it's leaning against the wrong wall. You realize that you've just been grinding for something, and you weren't even clear on what you're trying to achieve. And then you get to the top of the ladder, and you're like, I'm leaning against the wrong wall here. I was working for this goal I didn't even want. So you have to get really clear, that vivid vision, that clarity on what your goals are, what your timeline is to achieve those goals, and what your core values are. What, like the integrity, whatever, service before self, whatever they are, your core values are, family, trust, whatever those are, you have to put those down. Then, now when you're networking, right? So now you're networking, now you're going to these networking events, you're going to these meetups and these conferences, instead of just, grabbing business cards and finding people that had, they're Aaron, he's a good, we had a couple cocktails. He seems like a good guy. Let's go do deals together. You have like this checklist in your head now, where you're just going down like interview mode. Like, you're like, all right, so does this person complement my weaknesses? Does this person like doing the things I don't like doing in the real estate game? Can they sit in the seats that I can't sit in of those 5 seats? And then most importantly, are their goals, vision, timeline, and core values aligned with mine? If once you start going down this checklist and they start hitting that, you're going to find a team where you're in alignment and you're rowing in the same direction. Another failure that I had, and this is a failure in my team that I had, was we all started in alignment. But then what happened was after the second or third deal, they stopped showing up to meetings. They stopped putting in the effort. And this is at first the resentment starts building. Like, what the heck? I'm having to pull all this extra work. I'm going to do this. Like, what's with this guy not showing up anymore? And the resentment and the hatred and and they're getting the same equity I'm getting. And all these things start bubbling up. And really, after looking back and reflecting and honest myself, it's my fault because we never talked about this. And the issue boiled down to our goals were so misaligned that he was just working at the level to achieve his goal, which was much lower than mine. And my goal was way up here. So my work ethic, my commitment to the team, my commitment to doing deals was like, I'll work every weekend because I need to achieve my goal. Where he was like golfing, right? Because his goal was so much lower. By the third deal, he had already achieved his goal. And so he's like, I don't need to show up to meetings anymore. And his work ethic and commitment started wavering and waning off because he was satisfied. I was still hungry. So all of that could have been avoided if we were just in alignment at the beginning. So having those crucial conversations up front and being honest with yourself and these possible teammates, I promise you will yield much better, long-term, more fruitful relationships that are, not resentful. You're building resent and you're growing together. So that's what I got for my 2 cents. And both of those lessons are personal mistakes I've made that have cost me very uncomfortable conversations and probably a lot of money.
Yeah. No, that's incredible. Thank you for sharing that, because I think a lot of people do enter partnerships haphazardly. And even if they've had a couple conversations, maybe they've had a coffee meeting and they're like, hey, we want to, get rich. Do you want to get rich? Yeah. Okay, cool. Let's do a deal. But like, it's never only about money, first of all. And second, like, obviously, like, you have to be able to grow together. I think in some ways it's the same principles as a marriage, right? If you meet someone and you're young and you like doing the things that you do when you're young, can you also picture growing with that person over the different phases of life? And obviously a business partnership doesn't have to be forever like a marriage might or should be. But it still has to be built to last through different growth and phases. So thank you for breaking that down. And I think we kind of buried the lead with this interview, right? And I did that intentionally. The $100 million plus portfolio is a nice headline, but I think the lead up to that is really important to outline. But now you mentioned you have 6 companies, you have $100 million, plus under management. What are the 6 companies and how do they all kind of relate to each other?
Absolutely. So I have my real estate company. I have two real estate companies, which are the holding companies, vast majority of that number. Then I also I do home service companies as well. So I have a insulation company, like spray foam, cellulose insulation, home insulation. And then I have a flooring company. That's 4. And then I have the property management company. We went vertically integrated last 2 years ago. So at a separate entity. So now we self-manage all of our properties under another entity, Black Sand Property Management. We self-manage through that entity as well, have a staff and everything for that. And then I have the coaching and mentorship company as well. So that original coach and mentor I told you about back in 2018, I was a student back then. Then I came back as a coach in 2020. And then recently this year, I ended up acquiring the company. So now I actually own the original company that taught me and literally changed my life and, my kids' lives and their kids' lives for, this generational wealth. I ended up acquiring that company as well. So kind of crazy turn of events there. But I think that was 6. I think that added up to 6.
Yeah, that's amazing. So you acquired the coaching and mentorship company. What about the other services companies, the flooring and the installation? Did you buy them or did you build those companies?
Both. So for the installation company, it's a franchise. I started the first one. I scaled it up to 12 territories, and I scaled it through both purchasing more territories and acquiring a competitor. So there's a little bit of M&A there. For a period, for about 2 years, I was the largest in the country for size. So I had 12 territories, but I have since kind of toned that one down. So we're down to 7 now. So 7 or 8 territories now in that franchise. And that was both so I started and I also acquired one of my competitors, my neighbor competitors for that company. The flooring company was also an acquisition as well. That was actually a real estate play that I was buying the real estate and I didn't know that they were, interested in selling the company as well. And that kind of came out through due diligence and later on after we were looking at the deal that they were just going to close the store. And so we started talking about that, and I ended up acquiring the flooring company as well. And I really like home service companies. They're very simple to understand, to build your systems, your processes. And once you kind of figure out one, they're all pretty much the same. So like the insulation, the flooring, the plumbing, HVAC, they're all like 80% the same. So I can have this template now. I can just kind of copy and paste as I find more of these opportunities to kind of bolt onto the portfolio.
Yeah, that's really cool. And there's a framing that Nick Huber, if anyone knows him, he runs a Sweaty Startup as his brand, and he posts a lot online. And I've listened to a lot of his stuff. He's probably not the first person to say this, but he did a similar thing where he was buying companies that were adjacent to the real estate, that he was using. And he has this thing called, turn your cost centers into revenue centers. So he was spending a ton of money on cost segregations. He was, spending a bunch of money on VAs, and he just started acquiring those companies.
So the way that it's actually really funny, and I'll add to it. So the way I look at it, because I'm the asset manager for Tri-City, so I'm looking at the P&Ls, and I'm like going down. I'm like, which one of these contractors are getting all my money? Oh, plumbing. All right, looking for go on BizBuy now. Look for plumbing. Oh, landscaping. You're next. So very, very similar. Is I'm kind of going down the P&L of my real estate portfolio and looking like who's getting the biggest chunk of our money, and how can I acquire that, bring that in house.
Yeah, no, it's incredibly smart framing, and it makes sense. So some practical questions and maybe logistical questions here. Were you still in active duty, like W-2, when you were doing all this?
I got out of I left the military in 2021. So I don't know exactly the portfolio size off the top of my head, but I probably had maybe 400 units at that point in Tri-City Equity Group. And then I was just starting the franchise. So the franchise actually came because great lesson here. So I was leaving my W-2, and I had enough passive income to kind of replace it. Like I hit that critical mass where I can make the jump. But I've been denied for loans before, even though I had the income, but it was passive, and banks don't like passive income. So if you're listening to this and you're like, all right, I'm going to go get some rentals, I'm going to have this passive income, and I'm going to, live my life and everything like that, it's going to become an issue at some point when you want to go get like a loan, like a car loan or a house loan or something like that. And all you give them is a bunch of like,
Rental
K1
properties.
or something like that, right? Or, your apartment passive income or your house passive income. What's going to happen a lot of times, and it happened to me, was I got denied for a loan, even though I made way more than enough, because they're like, we can't take passive income. We only take, or we take it, but we discount it by like 50% or whatever their underwriting, model is at that particular bank or credit union. I wasn't aware. I was like, I didn't know. So I had to figure out, I was like, all right, if I get out of the military, how am I going to replace my W-2 income? Even though the passive income's there, I know that if a lot of the banks won't use all of it, or they'll discount it. So that's a problem that you're going to have to deal with and have a plan for. So hopefully that helps some of you listening. So what I did, that's where the franchise came from. I was like, well, I'll just go buy a franchise. The absentee owner type model, which is kind of a joke. So no such thing as absentee owner franchise. But definitely just marketing BS, because definitely hands-on, a lot of work. But that was the idea, was I'll buy a franchise. I'll give myself a W-2 out of that as the owner, CEO, whatever. And now I have a piece of paper. If the bank asks for it, here's my pay stubs, here's my W-2 if I want to go get a loan. Because otherwise it takes so long for them to underwrite like a real estate portfolio of like trying to figure out your credit worthiness and stuff like that, rather than just giving them a W-2. So that's where that initial business came from. Otherwise, I would have been all in only on real estate at that time, because that's what was working for me.
Yeah, there really is an ongoing trick, especially if you have a decades-long real estate journey, of remaining lendable. And I think there's a lot of people maybe don't think about it, or they love taking tons and tons of write-offs, which, obviously that's a benefit. But then if you go to apply for a loan and you're showing huge losses, then they don't like that.
Yeah, exactly. Then it's like, well, that was depreciation. And they're like, yeah, but you were still like negative $800,000 last year. I'm like, yeah, but it was like depreciation. And you add it back. So it's, yeah, you're exactly right. It's definitely a balance between, getting the best tax treatment through the laws that are out there that we can take advantage of, and then also being lendable. And that's also what'll stop your smaller properties as well, doing conventional loans, because that's the hardest to get once you start getting into these the commercial loans and stuff like that is the conventional loans are start getting much harder to get.
Yeah. And I want to double back too to what you were saying about when you first got mentorship and avoiding mistakes. A lot of people have a hard time with the idea of whatever the cost for that mentorship was whether it was $1,000, $5,000, $20,000. People are like, that's expensive. I'm spending too much money. And it really is. It's an investment, and the fact that you could avoid $100,000 mistake and it only costs you $5,000 or $10,000, right? It's like these tax things are an example of something where someone with a seasoned mindset and understanding and experience could see that around that corner for you and help you think things through before you take an $800,000 write off just because you want a quick refund that year, right? It's like all those dimensions to this whole wealth building journey that you might not be able to think of as you're carving your own path. That's why in my mind it's important to have people who have been there, done that, so they can see the things that you might not. But as far as you mentioned the book, The One Thing, and obviously 6 companies, it's hard to have one thing. You said earlier that, sometimes what you do is you take one of those things and you put your intensity and all your focus towards that until you build it into where it needs to be. You're a systems guy, you're an operations guy. So my guess is that's what you did, right? Is that you built these things individually. You got them to a point where they were systematized enough that you could then go on and focus to the next one. Is that accurate, or was there more to the story?
No, that's the idea. So that's pretty much what I built. The hard part now is kind of keeping them at that level and making sure they don't start degrading, because systems start degrading as soon as you start taking your attention away from them. So making sure you can build the system process, but also get the key people in place that have that sense of accountability and ownership to keep them operating and stay close enough by that if they start wavering, you can kind of jump in and get them back on track quickly. That's the balancing act, so to speak. Now for me is making sure that the system processes I built are being maintained, and I got to just kind of keep the checks and balances in place, or whatever we want to call it. And that's mainly what I do now. I have GMs in all my companies, so I'm not the one in operations, the day-to-day operations. I'm kind of just looking at KPIs and reports and stuff like that, and doing my normal weekly check-in calls, and trying to catch trends and stuff like that before they become big problems.
Do you use EOS or any other type
Absolutely.
of? Yeah. So why don't we maybe
I
just
think it's a must. I don't care if you're running a lemonade stand, like you should be doing it on EOS. Like,
let's do the 30-second explanation of what EOS is.
Sure. So Gino Wickman created this process called the Entrepreneurial Operating System. The book is called Traction. You can get the smaller book, I think, is called Get a Grip. If you want like the quick hit of what this process is, called Get a Grip. Then you go into Traction, and then you have Rocket Fuel. So those are the 3 books you got to get. They're very digestible reads. And what it is it gives you a framework to pretty much run any business efficiently, and more importantly, with accountability. So it has everything into, all of you set your goals, you turn your goals into the kind of quarterly, we call them rocks. And then your quarterly rocks, you kind of identify your strengths, weaknesses, or your things that are going to kind of obstacles in your way for that. And then you start attacking it, and you do it on a daily and weekly pulse. And it's essentially non-negotiable. Like these things, like these daily stand-up huddles, non-negotiable. Your weekly pulse level 10s, non-negotiable. You're going to go through the numbers, every number. The big part of this is accountability. That's what we're getting for, is not just going through the motions of stuff, but every target is assigned to somebody, and they're accountable for that number, that KPI, that process. And that's what really is the secret sauce of this thing, is getting people to buy in, get ownership, and being able to have crystal clear accountability of who's supposed to be doing what. And I think that is, that's pretty much the secret sauce of the EOS.
Yeah, it's founded on such a simple idea that people should know what they're accountable for. And it's kind of crazy how many people have jobs that they don't know what their primary responsibilities are, or they don't know what they're being measured on. And it is an interesting kind of weak spot in especially big corporate environments where they kind of think they're measuring you in a certain way, but you ask somebody what their job is and they can't give you a super clear response. So I think EOS and that whole system, all the books you mentioned are incredible. And it feels obvious once you actually read it, but it's interesting how it's not obvious in a lot of contexts out there. So
I would say it's one of those things it's really easy to understand, extremely hard to implement and stay consistent on. And I'm not even like if I was honest with myself, I'd probably rate me as like a C plus on actually implement it. And I still do. I do my weekly calls and we do, but I know I could do more. But it's one of those things you're just always trying to get better on and things like that. But just doing it even at my level is still like huge leaps and bounds improvement over not having anything in place.
Yeah, and it's the same principle you were explaining earlier, where like you can underwrite a deal, you can build out a pro forma for a big complex real estate deal, and then when it comes to actually executing, it's a totally different skill that has to be practiced and learned with repetition, mistakes, all that stuff, right? So coming up with the plan and the framework, going and reading traction is very different than actually implementing it in one of your businesses. So I'm sure
Yeah.
you continue to learn and evolve, as you get further in your ownership journey.
And one of those things, to kind of tie it back to an earlier concept, we were talking about the strengths and weaknesses. And after reading Traction, EOS, all that stuff, and then especially Rocket Fuel. Rocket Fuel was the book that I was like, wait a second, I maybe I'm not the integrator I thought I was, because I have trouble sometimes being consistent on things. So rather than me trying to sharpen that tool, I'm like, I'm gonna go find an integrator that like thrives on the consistency and like the process of just doing things, where I can be more of that visionary type role that I find myself sliding into. So that was a big kind of aha moment too, where I was trying to force these things. I'm like, wait a second, maybe I'm not the best person to run the day-to-day stuff. And that's where, we made a pretty big pivot on that too.
Yeah, just being self-aware and putting some thought up front can save you like so much time and heartache and arguments and inefficiencies in the future, right? So it's just like encouraging people to think along those lines ahead of when they're actually doing something. So, well, I've learned a ton from this conversation. We could probably go another hour just because of the depth of experience you have. And I know I certainly have a lot of follow-up questions, but in the interest of time, I want to get you out of here on time. But where can people find you if they want to learn about your coaching or just learn more about your journey?
Yeah, I'm on all the socials. So Vincent Gethings, Instagram, Facebook, LinkedIn. Reach out to me on there. And if you want to learn more about the Wheelbarrow Profits Academy, that's that coaching and mentorship company I acquired. We put up some pretty big numbers. We got 1,400 people. I think 5 billion. We're over 5 billion in assets acquired. 80,000 units from our community. So we put up some pretty big numbers. Wheelbarrowprofits.com, or just reach out to me and you can ask me, Vince at Wheelbarrow Profits. I'll give you more information on that. And yeah, I'm open to talk to anybody that's interested.
Awesome. Well, I'll make sure we include all of those links in the show notes and reach out to Vince. I like I said, I learned a ton and I'm looking forward to staying in touch. So thanks for coming on the show, man.
Thanks, Aaron.
Thank you for making it to the end of today's episode. As you may know, podcasts are very difficult to grow organically. If you're getting value from today's episode, I'd deeply appreciate if you can take 30 seconds to leave my show a 5-star rating and review. This will go a long way to helping me reach more listeners just like you. Thank you so much in advance.